Hello, my name is Dave Shepson. I am an accountant and instructor. I've been teaching for a few years, and I've put together a series of videos to help students with particular concepts just to make it easier for you if you're taking Accounting 1 or reviewing different accounting concepts as you progress through your education. This is one of the basic, most foundational, maybe probably the first one you should watch if you're in Accounting 1. And it's about answering the question, what is that? And we're talking about how to identify accounts. First of all, let's just talk in general terms about naming and why we name things and what that does for us. This is a picture of your brain. Well, maybe not your brain, but somebody's brain. A name is like a handle, something we can grab onto that explains to us something about a category. And it helps us categorize what we see in the world around us. And those categories associate with them certain attributes or characteristics. So the name is kind of like the hook that you hang everything on. And the attributes are the things that hang from that name that we associate with them. And that, we interpret all that to help us decide what to do with whatever it is we're looking at. Now, that's in the abstract. Let me bring it to reality here. What is this? We call this, our eyes see it, and our brain interprets it, and we have learned the name for this. This is a lion. And I know that a lion has certain attributes, one of which is, if given the opportunity, it will kill people. Okay, so what do we do with it? We run away. And this is the power of naming. Naming associates all of this with our brain. This video is going to be talking about the very first part, seeing something and attributing the right name to it, and hopefully will help you with the rest of the process. So, what categories are there? Animal, vegetable, or mineral? Well, in accounting, we don't have animal, vegetable, or mineral. We have other things. We have assets, liabilities, and equity. And that is the accounting equation, which hopefully you learned in probably your very first accounting class. The total of our assets is equal to the total amount of liabilities, or equity. I think of it this way. A company has a fixed amount of assets, anything of value, basically, that they own. Well, all of those assets somebody has a claim on. And there's only two possible types of people who could have a claim on that. The owners of the company, and that represents the amount of assets that the owners have a claim on, is represented by equity. Or third parties that the company owes money or something to. And so the amount of assets that somebody else has a claim outside of the company to would be represented by liabilities. And that's why they always balance, because 100% of the assets are always claimed by somebody. So we would say it always balances because all of our assets either our owners have a claim on or third parties have a claim on. But you can't have more than that. So let's talk about assets. Assets are something that have a value. They have a measurable value. They can be tangible or intangible. For example, like a trademark or copyright or patent may be very valuable, but you can't touch it or see it. Tangible assets are easier to understand. Cash, equipment, buildings, tables and chairs, things like that. So accounts receivable is a common asset. That is a debt that is owed to you. It's not cash that the business has, but it's a debt that a customer typically owes the business. Of course, cash is an asset. That's an easy one. Equipment, trademarks, prepaid expenses. In other words, if you pay, say, for insurance for a year, it's not expensed right away because you haven't really used it. It's a year's worth of insurance. You may have only used, a month of it or something. It's a prepaid expense, so as of right now, it's an asset that you have. Liabilities, on the other hand, are something completely different. Liabilities are a debt. it's a claim on assets. It's a claim on assets by somebody outside of the company. So think of it as an IOU. Common examples would be accounts payable when we buy supplies or inventory or something like that, and we have to pay within a certain time period. That would be an accounts payable. We owe that much. Notes payable. A notes payable is a more formal instrument that is still a debt, but it's usually over a longer period of time and has interest and things like that. Credit cards are other types of debt or liabilities, mortgages, long-term loans, salaries payable. Your paid check may come the 5th of the month, but you earned it at the end of last month, and so it would be a payable, so they could record that expense at that point. Equity is mathematically just assets minus debt. Think about the equation again. So if I look at the equation and I say assets is on one side of the equation and liabilities plus equities is on the other side, if I move my liabilities over to the left side of the equation, I have to put a minus sign in front of it. So mathematically, assets minus liabilities, the difference there is the amount of assets that the owners have claim on. That's the net worth of the company. Think about, it can be negative. Think about the housing crash that happened in recent years, and a lot of people had a mortgage on their house that was higher than the value of the house. And so they had negative equity. And equity can be a negative number in some circumstances. But it's the owner's claim on assets. So for a partnership or sole proprietorship, the account would be a capital account. For a corporation, common stock, or stock, things like that. Then we have temporary accounts. These are a little different. They affect equity. All temporary accounts will ultimately affect equity. Revenue, or any type of sales account, income accounts, are temporary accounts. They get closed at the end of the accounting cycle. And expenses, they again get closed. And we also have draws. Now the thing is, these are not in the accounting equation. So how do we handle them? We also have contra accounts. We're going to come back to how we handle the temporary accounts in a moment. We have contra accounts. And those are contra because they're contrary. They're paired to a main account. And they have the reverse effect on their paired account. So an example would be accumulated depreciation. When we depreciate an asset, instead of just decreasing the asset on the books directly, we have this sub-account, this contra account, and we accumulate the reduction of value, if you will, of that asset in accumulated depreciation account. Draws are a contra equity account. We show, instead of taking directly out of, say, capital, we show how much we're taking out during a month through the draws account. Sales allowances would be a contra income account. They have the opposite of sales, so like discounts and allowances, things like that. It's a reduction of income, really, so they're a contra account. So before you do any accounting, you have to know what you're dealing with. In this example, if we purchase supplies and we pay cash for them. So we have supplies and we have cash. Supplies is an asset, so is cash. So we have just traded one asset for a different asset. And a lot of that happens, of course. If they receive a bill for utilities, what we have is utilities, which is an expense. That's a temporary account, but it does affect equity. And the bill is a payable. It's something that's due. That's a liability. And this is going to become very important when you go to actually make journal entries and you have to know whether to debit or credit something. You need to know what kind of account you're dealing with first. That utilities expense, by the way, and all the other temporary accounts get closed at the end of the period. And the net effect of all of those accounts is either going to increase or decrease our equity. So all the activity during the month that doesn't show up on the balance sheet during the month is going to end up showing up on the balance sheet through a change of our equity at the end of the period. So here we've incurred an expense and a liability at the same time. You cannot do accounting and learn accounting without doing a lot of practice. So I'm making the assumption here, you're doing reading, you're doing homework, you're doing a lot of problems, and doing a lot of practice. But review the attributes of the categories of accounts, because that will save you time and make it easier when you're doing that homework or whatever you're doing. So you need to answer the questions. Well, how does it act? What does it do? When is it used? If you understand the category, then you will probably identify the correct account and handle it properly. And then it's very important that you use the language. There's a lot of language in accounting and words that are used that have other meanings in common language but have specific meanings in accounting. And in accounting, precision matters. The words mean specific things. So, for example, revenue and income are not the same thing in accounting. Revenue represents the receipts that you receive, the monies that you receive for providing a product or service, or any other type of income that's earned. But income in accounting has a very specific definition, and that is there's different types of income, but income is always the effect of revenue minus some type of expense. That's one example. Common things that get confused. An asset is not the same thing as revenue. Now, when you earn revenue, you generally are obtaining an asset, such as accounts receivable or cash, but assets and revenue aren't the same thing. They're on different financial statements. They mean different things. Revenue is an amount that was earned during the period. An asset is something that the business owns that has a value. A liability is not the same thing as an expense. A liability is a debt that is owed. You can incur a liability when you incur an expense, like the example that we showed earlier, but you could also have just paid that with cash potentially and not incurred a liability. So, review the attributes and then get a lot of practice and go name stuff. And I would recommend after this video, when you get into doing journal entries, that you review the debits and credits and bears. Oh my, it will probably save you a lot of heartache.